Good evening, everybody. Welcome to tonight's webinar. We're going to be discussing trading using price action. Now, before we get to the actual webinar, as always, please take a moment to read through our risk disclaimer. That should be long enough. All right, so what we're going to discuss today. First of all, introduce myself a little bit so you have an idea who the hell is talking. Then we're going to discuss what price action really is, how it kind of came to be, and why do we use it, or why can you use it. Then we'll look at price action and we'll look at different candlestick formations. And we'll look at a few different categories in the price action department of chart development. And then we're going to discuss how to actually apply this to your trades if you do want to. So what kind of steps do you go through with price action before you actually initiate a trade or abandon a trade? For those that are at the webinar, obviously you will all have the availability of the Q&A at the end. And this will be after the first thank you for those on YouTube that are watching the video or the recording. So about me, who am I? So my name is Mike Rotting. I live in Athens in Greece with my wife and kid. I'm originally from the Netherlands. This is where I studied international business studies at Cambridge, diploma through Delvium College. And during my time there, I got bored and was trying to look for something that I could do. And I stumbled upon basically trading, right? Forex. Like most of you, first account, obviously I was a lot younger and a little overzealous. So yeah, first account didn't go too great. Obviously I also looked at completely wrong YouTubes, like, hey, how can you make money fast in this market and do this and do that? All these self-proclaimed superstar traders and stuff like that. Yeah, pretty fast that you find out that doesn't actually work. So yeah, that costed me 2 accounts. So the third account, I actually said, okay, let's do this completely different. Let's start from scratch. Let's learn one thing at a time and really start digging into it and building it up and do this the right way. Well, you fast forward that 15 years and yeah, that account became successful, and out of that, I understood what to do and what not to do. Obviously, I still learned some things along the way, and since then, the last 10 years or so, I've been profitable consistently on a yearly basis. Then I rotated a little bit more outside of Forex into other types of investments like structured notes, offshore investments, and stuff like that, where it's less me doing the work and more other people doing the work. So that's me in a nutshell, which brings me to what do I do? So apart from obviously these webinars that I've now been doing for about 5 years, trying to pass on the knowledge that worked for me to everybody, hoping that some of the initial mistakes that I ran into, that you can avoid those and get a little bit faster to the finishing line than I did, for instance. On top of that, obviously, I do mentorship for myself or for people that want to learn trading. And on top of that, I'm also involved in the financial services industry now, where I'm also studying to become financial advisor through CISI and looking mainly for offshore investments and investments in general to broaden my horizon on that spectrum. So that is basically me in a nutshell. Now, what you came here for. So what is price action? Okay, so price action is basically a trading technique that we use to read basically the current market. Now, what we mean by that is that it's basically as old as candlesticks are. It's a pattern composition of different candles doing a certain pattern, and where we just historically see that when a certain set of candles together make a certain formation, what we call now price action, then usually the market's reaction is a fairly predictable result of that formation happening. Now, that doesn't mean it always happens. Obviously, there's no such thing as a foolproof system. And this is also why it is dependent on your technical analysis tool. So it's not on its own that you could, for instance, like a naked blank chart and just use price action. You'd still get a pretty good accurate rate if you read all the price action correctly and do all the applications correctly, right? Some of them have about a 60% consistency, others have an 80% consistency. But if you would take the average, it's like 70 to 72% of all price action has then a certain predicted continuation afterwards of what it historically does. Now, this is why it's such a strong tool to use, because it could be a decision-making tool when, if you've done your technical analysis, right? So it's dependent on your technical analysis tools. So let's say you've done your technical analysis, right? So you've done your resistances and supports, you've done your trend lines, you have your indicator set up. These are all technical tools that you can use. You could use Fibonacci or Bollinger or whatever it is that you might be using. Anything that's applied to that market. Let's say you see that the market is, let's say you're in an uptrend, you're at the bottom of a channel, it's at the bottom of that channel on the trend line, and it's near resistance. It's starting to stall out, and now it's creating a certain candlestick pattern, because you know that if you want to buy the bottom of the market, or the bottom of the channel would be the perfect time to do that, to go with the trend, let's say. You then wait for the price action candle to close, and then you have your confirmation of price action, and it gives you that extra confirmation to go in. So you already had this expectation. Let's say in this scenario, all the indicators will also align perfectly fine, that they were bottoming out as oversold and they were getting ready to turn around, or they just hit their signal lines. And then on top of that, you now get a price action confirmation, which then is, just that one extra step to then enter the market. Now, what's very important to understand is that any of these aspects, if you take them individually, you'll get a lot of false signals as well. We've all fallen into that. If you combine all this information together, you just basically what you're doing is you're putting different layers of confirmation on top of each other that all need to say the same thing at the same time. And if you then trade only on these moments, this is very applicable to people that have a smaller account where you don't have the room to make many mistakes, or you don't have the room to compensate otherwise. Doing this means you will trade slightly less in frequency, but you will trade higher quality, right? So that applied with a bunch of other things like your risk management setup and everything else, variable lot sizes, proper stop loss and everything. Once you get a hang of all those basic elements, you're basically already 85% there into just becoming consistently profitable on a yearly basis. The only thing that differs then at that point is basically the experience in the market to reading like these exception moments, or when fundamentals, like in the webinar I did last week about fundamental analysis, when you, for instance, have a fundamental announcement or an economic announcement coming that could disregard the price action of the natural market movement. Okay. Now, price action, because it is basically a candlestick pattern or a chart development pattern, it's multi-applicable. What we mean by that is it's not just a Forex thing or just a commodity thing like some things are, or just a stock thing. You will find that price action fits everywhere. Now, they have slightly different shapes and sizes based on how these candle patterns work. For instance, in stock, if we take one, let's say an evening star, and we're going to look at that in a minute, but in an evening star, the pattern would look slightly different than it would look in a major, right? In Forex, the candles are usually connected to each other, meaning wherever it closes, the next one opens. In stock, you usually have small gaps, especially if you're trading on 4 hours, for instance, or an hour. And these gaps then also have a different meaning and how these candle patterns needs to develop. So again, this is a little bit for down the line when you have an account that can properly trade CFDs and you can do all this kind of stuff. But generally speaking, this is something that, will take a little further refinement and digging into before you start applying price action. I will give an example later down the line. Okay, so all of that in general is basically what price action is, right? So it's a technical tool. It's been around since basically candle charts have been developed. It's dependent on analysis, technical analysis tools, right? You do use it in conjunction with everything else, and you can apply it no matter what you're trading. As long as it has candles, it has patterns. Okay? Right. So let's look at some candlestick formations. So a doji is quite often mentioned when we're talking about price action. And we're going to go to a chart and look at these 5 in a bit. I'm going to explain them a little bit, and then we're going to look in a chart what they actually look like. So a doji itself is actually on its own not really a price action, but it is the foundation of the majority of other price actions that are built upon it. Apart from several formations of candlestick or of chart development, where doji has a different rule, but in general, with candlestick formation, doji is basically involved in most of the combinations of other candles. Now, doji is either a small cross, which is literally just you have a wick and a tail, and you have a flat line, so there's no buy, there's no nothing. Basically, whatever the time frame you're looking at, so let's say it's an hour. In that 1 hour, it moved up, it moved down, and it closed where it opened. Right? That cross would be a doji. And we're going to look at that in a minute. Now, I'll get back to that in a minute, Ninja Blue. So there's another version if you have a cross, but it has a very long wick and tail. So it's basically a cross, but just a long wick and tail. Well, we call this a long-legged doji. It is the same concept because the market still went up, went down, or down first and then up, but it closed at the opening price or near to the opening price. And we're talking about a pip or two, right? That's the maximum. It basically is a flat line. If you would have traded that hour, you've done nothing. You've just waited an hour for it to go up and down and you close at the same price. The 2 other versions are the gravestone and a dragonfly. The gravestone is literally an opening that went up and then went all the way back down to the closing without or barely any down. So you basically have a long wick with a flat line underneath it. So like it's a pedestal, it's like a candle. Okay? And a dragonfly is if you just flip that upside down, so you basically get a T, the T for tango. That's what it looks like. And these doji formations will come more relevant if we look into further things where you get bodies and hammers and things and pin bars. This is where we start looking at dojis and you'll start seeing them come back. And doji is usually an indicator that, hey, price action might start to develop next. Because one thing happens when a doji makes is that whatever market movement it did during that time frame, so if you're looking at an hour, it's an hour doji. If you're looking at a day, it's a day doji. But whatever it did, it means that the price basically did not change in whatever time frame you're looking at, meaning there's an insufficient amount volume of buy and sell. They're basically equal for that period. During the period, something may have happened, but the end result is that nothing happened. Right? So for instance, it opens at 1, it went to 2 and then back to 1, and that's where it closed. Yes, you had 1 to 2 movement, but in that time frame, realistically, nothing really happened because it only went up and down and closed at the same time. So when you're holding a position for a longer period of time, you would not have gone anywhere. Okay. Now, so let's go to an Harami cross. So there's a bearish and a bullish version of Harami cross, and they both have the same concept, except you flip them around. So an Harami cross is, let's say we have a nice green up candle, and you will see that Harami cross is one of these things that are multi-applicable, but more common in stock than they are in any other thing. Stock and commodity, you'll find Harami cross more. And this is because in commodities and stock, you have more jumpy behavior in the candlestick openings and closings. Meaning that, let's say the green candle started at 0 and went to 2, but the next candle opened at 1.5. Right? You have this little gap of opening. This you will see more often in stock than you do see that, especially in majors like Euro US dollar. It barely ever has a gap opening unless it's over the weekend. right? So this is where you could see a pattern like this develop. But what it is let's say, so our green candle started at 0 and went to 2. Don't worry, you'll get a visual cue in a minute. We're going to go to the chart and I'll show them to you. So it goes green, and then the next candle opens somewhere in the middle or just underneath wherever it closed. And then it has a wick and a tail, but the body is contained, including the wick and tail, are contained within the previous candle. But the body has the opposite color, or the opposite direction, I should say, because some people aren't sure of color, right? So let's say that we had an up candle first, and the next candle is a down candle, but the body is, let's say, contained within the body of the previous one, including wick and tail. These two combined with each other is called a harami cross. So let's take a look at the first two examples. And if I'm not mistaken, I put the harami cross here. Yeah. So here you have a good example of a potential harami cross. Now, obviously, if I do something like this, oh wait, I have this chat window in the way, right? Because now it's obviously a bit obvious, but the market's been basically stalling, right? So we had a big uptrend, and this is stock, this is Adobe. And like I said, you will find this more often in stock than you will find it somewhere else. Right, here's one of the doji formations that we were talking about. This is a T, so this is what we call a dragonfly. Okay, this is a long-legged. So here we have two different doji formations. Individually, they don't really mean anything. But these two bin bars do. We'll get back to that in a minute. So here we have an uptrend that stalled out and basically hit this resistance right here. It stopped, went back down, and then created this bottom here. Now, you can play with that a little bit with wicks and everything else, but this is the new bottom. So this is where we're floating. Now, as you can see here, nothing really develops. There's nothing specifically in a candle pattern sense until all of a sudden this happens. We have this big down candle, or this down candle, and then you have this gap opening. This is where it closed, but it opened over here. So you have a gap. Right, this one closed here, opened there. Let me try and zoom in, by the way. That doesn't matter. You know it's going to go up. So this one closed here, opened there, went down, closed there, opened here, went down, and all of a sudden you have this gap opening. All of a sudden it opens here instead of here where it would normally. It did, however, then go down, back up, and go back up. Now, this almost looks like a doji, but you can see that it's slightly elongated. Obviously, we're zoomed in very much right now. But even if this body was a little bit longer, it would be even more perfect, because then you have our Harami cross, which is, as all price action indicates, a potential reversal. So here it's indicating, hey, look, I'm now going to start making a decision on which direction I want to go. It's been basically consolidating from basically here. Well, this is all consolidation. Even up to here, it's still consolidation, right? But here's when the first time it went out. So if you would be looking for a trading opportunity, you're at the bottom of the channel here, sort of, you're halfway there. And now you were deciding on the next candle to go in. So when you go in, let's say you go in here at the closing of the candle. Okay, so I'll make that a little bit different. Bloop, bloop, bloop. And I'll make it green. Whoops. So the candle indication now says like, hey, look, I'm going to decide for a buy. Harami cross confirmed. Right? I want to go up. Well, let's see what it does. And you can see that's exactly what it did after that. The next two candles, this one is a confirmation close. So if you are holding your buy here, and this is the question I get a lot, when do you decide when to abandon it and when to keep it? Here you have your confirmation. It closed outside of the resistance. It hasn't done that before. So this is where you hold. What you could do is whatever your stop loss was, probably over here, move it to plus so you secure your entry point just in case it is a fake out. And now we go up. Now, as we're going up, we now get to this point where we get another doji formation just after this candle, which again is an indication like, okay, a candlestick pattern might start to develop. So if you're wondering like, hey, how do you decide to go out? If we zoom out and you have your other information, for instance, your indicator will now probably tell you that it's oversold and overbought and everything else. You just left that point. And where are we? Here. So it just closed underneath it, and this one is pushing through, and then you get this candle, which means it doesn't actually really want to break it. It's kind of lost its steam, right? Otherwise, this break would have pushed it upwards, but it didn't. So this is your indication of, hey, here is where we close it. And this is basically how doji and a harami cross are working together to tell you, hey, this is what the market is doing. And these are the price actions that we use. In this case, it's a stock example where you could read the market. And if you would have taken that trade, what was this? 250? Yeah, 290 pips. Now, obviously, this is just CFD, so the lot size are a little bit different, but we'll take that out of account. So that's 290 pips that you get there for free. Right? Even if you went in late, let's say you went in after the confirmation here and you waited for this and the first candle goes down, you still have the confirmation. You have a Rami cross in, you decide to go in late. So you go in here, your original stop loss then would be somewhere under that candle because it needs to go back down in case of fake out. And your stop loss was, I don't know, you'll only look at the previous high. So you put it somewhere, well, this was the previous high. So you put it somewhere here. Then you would have hit it still. It would have still been a good trade. You would have been a lot later than me, and I would have gotten a lot more profit than you. But you still have the same safety. And I say that between air quotes. No, you can't see that, but that's why I'm saying it. There's obviously never a real safety in trading, right? We know it's a risky thing, but this is purely on the price action. Now, if you combine this with your indicators like, I don't know, RSI, stochastic, you have your triple moving average and things like that, you now get your confirmations like, hey, this is how a Harami cross would look and how it would work, right? So here, for instance, it looks like a Harami, but it's not, right? We have a candle with a wick and tail, and we have a body. This body opened where it closed, so there's now a gap, and this tail, or this wick actually, is above the body of the previous one. So it's not contained within. This is just barely contained within. This one isn't contained in at all. Okay, so that's what you need to keep in mind. We also don't have any doji formation before that, except for this lower gravestone, but that's been 3 candles ago. So it didn't develop anything after that. Right, so this was only like, hey, pay attention, and then nothing happened. Right? Okay. So let's take a look at a morning star and an evening star. They're basically two twins of each other, except opposite directions. So that's why I mumbled a bit earlier, like I consider them the same. If we look at an evening star, you're talking about an up candle followed by a small down candle. And I mean small, about 20% the size of the previous green one. Continued by another down candle that it then completely covers the previous green candle or up candle, whatever color it may be for you. Right, so white and black if your default. Right, completing the full cycle that, and in stock you need gaps here. So in stock, for an evening or a morning star to happen, the 3 candles need to have gap openings from each other. All 3. So for instance, you have an up candle, then a gap opening higher going down, but small, and then another gap opening the new down candle at the same level or slightly lower than the previous up candle and moving down. I'll try to find an example of that, but I'll show you in the Forex what it looks like in Forex, because there you do not need the gap opening. Here they're connected to each other. And a morning star is when you have 1 down into 2 up. Okay. So let's take a look at that. And if I'm not mistaken, I got that over yonder. Yeah, so here we find a doji again, right? Now in this case, it's combined with another pattern that we're not going to discuss today, but here we have a morning star. We have a candle down, and then basically a doji. So in this case, it's kind of dead. We would prefer to see this green, but in this case, it's a fake morning star, which means that it's not entirely confirmed, but it still did the morning star pattern afterward, which is a reversal of the trend. Now, sometimes these are a little bit hard to read because technically speaking, you want this one to be green. But you can see that sometimes you get the pattern that looks exactly like it, but it isn't. So this one was the morning star, right? So if I take this and shift it this way, it confirmed it here, down into 2 up. And it did confirm afterwards. But the only problem is, and this is why it's reliant on, it should have been here. This is why it's reliant on other technical aspects, is because, well, why didn't it then just turn here and just go straight down? Well, let's take this line here and let's see if it did adhere to other technical analysis. So let's follow it. Well, it didn't because it was past the resistance that used to be here, right? So it just kind of broke that. Roughly, let's say here, this is roughly the one where it just broke that, then it went back down through it, and then it went back down through it up. It's just like, it's very messy, right? This is on a day chart, by the way. But the next resistance was up here. And you can see that it basically just completed its run. So in this case, the way you would read this is like, hey, there is a candlestick pattern confirming that it wants to turn. But it doesn't have the pressure just yet because, for one, it's not at a resistance or it didn't break the bottom of the channel, right? If there was a channel here, for instance, this, right, just quick and dirty, it didn't complete it and didn't close outside of it. But here, you can see that it closed on the resistance underneath this line, and there you have the confirmation of another entry point, and you already had the confirmation earlier of a pattern that there's already a push potentially for a sell. Now, if we look into a smaller time frame, you will see this candle pattern come back here. So here we had a whole double, and we even had a double top. But here we started seeing that here you get your pin bars, and we're going to discuss those in a minute. So this example is a pin bar where now you are at your resistance, and this is on a smaller time frame. But in the bigger time frame, this is what a morning star looks like. In this case, it's a false signal, and this is why it's important to use all your technical analysis, like your resistances, like your supports, and your indicators to confirm whether or not this is actually in the right spot to follow up on its pattern. Like we said, it's not like it's 100%, on average 70%. So 7 out of 10 do indicate, okay, I'm turning now. And 3 of them are just like, well, you did make the pattern, but you're not doing it. And 2 out of those 3 times is because of news announcements. Right? Or there is a news announcement coming, or it got pushed into a certain direction by a news announcement, something like that. Right? Now, Evening Star, it's its sister, and it looks basically literally the opposite. We go up, red, red. So we were already going down, and in this case, this is just what the pattern looks like. So if you were deciding like, okay, should I keep holding? So this is for an existing trade. So let's say you went in somewhere over here with a sell, anywhere here, and you're wondering, when should I close my position? You now get this pullback into a pin bar into this thing. You now have a confirmation of price action that it does want to keep going on. So this helps you in the decision making of your exit strategy. Hey, this price action is telling me the market may very well keep going, so I will hold my position. But if you went in somewhere, okay, let's say you went in after it broke that after it broke this level. So you went in on this candle, let's say, and you had your stop loss somewhere over here. And obviously, a lot of you will take profit here, but some of you will look in the past and go like, okay, I can go lower. Can I zoom out a little bit? Because, yeah. So you had, let's say you had this. You would have hit that. Pretty solid trade, actually. But yeah, you could have held it longer. This is for those that do a little bit longer, what do you call it? Long-term trades, and you get used to it. Not so optimal for small. I'm doing this in a day chart just to show you the price action patterns. You will find these in an hour. You will find these in different things, right? So here, for instance, up candle, a small red into a long red. So let me just identify it for those that don't know where I'm looking. Right here. So you have this big uptrend, and then it stops into red, down red. That right there is an evening star. And the candle afterwards confirms that by it goes up a little bit, then it went down a little bit. This would be a semi-Arami cross, but we don't call this an Arami cross, by the way. This is a bullish squeeze, I think it's called. But so there's different candlestick patterns after each other. So you can have multiple price action patterns in conjunction with each other. But in this case, you have your evening star, and it did exactly what an evening star should do. After that, it just went straight down until we get this pattern here. Now these wicks and tails are too long, but the body is contained within the body, so it's a harami. So we want to go up. Confirmed by a long-legged doji afterwards, right? So, and then we get, this is another reversal pattern, right? Because here we see the same thing again. It got elongated, but this is the same pattern as this. Okay, so you have here, come here. You see the same thing again. Up, down, small, down, long. And there's your confirmation for another sell. Okay, so that is morning and evening stars. For those that are making questions, by the way, in the chat, just hold. I will read the questions in the Q&A and try to answer them there. I want to get through the theoretical position first because otherwise we might run out of time, and that would be unfair to others. Right, so a pin bar. So there's two versions of a pin bar. You have bearish pin bars and bullish pin bars, and it is determined not by the direction of the candle of the body. It is determined by which end of the candle the long pin is, or tail, or wick. So consider it a hammer, whether it's Thor's hammer standing up straight or Thor's hammer laying on its bottom, like this. This is a bullish pin bar. Now, in this case, it's combined with these three and this. I think it's called three crows. But that's also a pattern. But obviously, again, the candle, and so because you're going to have these candles like here, you have one, it doesn't mean anything. Here, it means nothing. Because it needs to be in combination with other technical analysis. Keep that in mind. It needs to be at resistances. It needs to be at trend lines. So you need to know how to draw your technicals. And if then on those technicals you get price action and your indicators are telling you also buy or sell signals, now you just have your confirmation, okay? On its own, the candle's never enough. But they are candles that you go like, hey, I should keep an eye on this. All right, so let's take a look here. So here we have a bullish pin bar. And this is what I mean. You have a small body and a really long tail. Right? So that's a pin bar. And like all price actions in general, they indicate potential reversal of the market. Now, pin bars especially we generally see them happening at resistance and support lines, where this, for instance, is the exact example we're looking for. Big tail, pulled back and closed above it, which indicates like, okay, there's not enough pressure for sell. There's not quite enough pressure for buy yet. As you can see, it went up after that and then it pulled back. And this shouldn't scare you, because if you would open on this candle at the close, or the opening at this candle, your stop loss would be underneath this pin bar. Right? So if your entry point is at the start of the next candle, which is here, whoops. Let's do this one. Right? So you start your entry at the next candle. You just go, let's say you go in blindly, which you shouldn't do, obviously, but let's take that for consideration right now. Your stop loss would be here, and now your take profit would be based on the previous high levels. So something like this. Okay. Now I know what some of you are saying. Yeah, okay. So, but it went up and then it went down and then it went up and then it went down and eventually it hit my stop loss here. Now we get to risk manage, micromanage, and stuff like this, because this went 70% towards your take profit. So this should have never turned red again. Right? You were obviously smart to calculate the average daily range and put a trailing stop in, and it will probably have closed somewhere over there. Still a profitable trade. Didn't complete the full set. Still a profitable trade. Okay, so we keep going. We keep going. We keep going. And now let's try to find another one. Here's another pin bar. So again, at this point, it's a little bit hard to tell if that's a resistance or not, because you're so low in the market. Now we're really looking at hourlies. So everything is a bit squashed. I'm just trying to naked eye find a few examples. Doji. We have any nice pin bar anywhere? Right on the resistance. Yeah, this one is, but let's see the 4 hours. Euro US dollars, Euro CHF is a bit wonky sometimes. But anyway, you get the idea of a pin bar. Right, so at resistance or trend line, long tail or wick with a small body in opposite direction of previous candle, indicating potential reversal. Everybody got that? Of course you do. All right. So let's take a look at the last one of the candlestick formations. We call it an engulfing candle. Does anybody have an idea what an engulfing candle could be? Yeah, I just threw a curveball. Who's going to answer it? Who knows what an engulfing candle? Because I know this one is very, very commonly mentioned. So a lot of people have heard of it. Who thinks they know what an engulfing candle is, or knows what an engulfing candle is? Not sure. Almost, Chang Chang. You're in the right direction, by the way. It's not just cover. It is a fancy word of saying covers entirely with extra. Yes, Charles. So yeah, it has to fully engulf. And for those that are not native English, obviously that doesn't mean a whole lot. But for instance, this is an engulfing candle right here. This candle covers the opposite direction candle before it entirely, plus a little bit more. That is an engulfing candle like this. Here we have a green candle turned into a red candle that is, in this case, 3 times the size of the previous one, completely swallowing the gains made by this candle, and in this case, the 3 candles before. That's also a pattern, but we're not going to discuss that. So that is your confirmation, and now you have this gap opening because that was Friday, but it just continues. Now, let's see, because this one is quite common in most pairs. So Euro GBP here, for instance, we have this nice little, we had an uptrend that pulled back down, and now you get this massive engulfing candle. And you can see here, big candle down with a nice wick and tail. And then you get this full body, big green up candle, completely swallowing everything it did. And thus engulfing the candle. And after that, it climbed a little bit. Here, the little bit of gains got engulfed, and then it just like continued on. Here, this is also an engulfing candle. It might be small, but it's still an engulfing candle because this candle completely got swallowed by this. And it did go up after that. This, it didn't. Now it created a different candlestick pattern because it's an up and 3 down. Creating the same, this is also called something else, but if you get too many patterns in your head from the start, you're going to start looking, just see patterns everywhere and forget which ones you're looking at. But here's a good engulfing candle again. So we just had a nice solid body with a wick and tail equal size, and then a massive green candle, which indicates that whatever this pullback was, it's over. And it's going to retest this resistance. Right? It was a support on this side. It is a resistance now because we're trying to go up. Different topic. Okay, so engulfing candle is pretty much very, very simple. You have one candle that is much bigger than the previous candle of the opposite color and completely swallows whatever the previous candle did. That is usually your indication. And again, like with all other price action, use your other tools to confirm whether or not it's in the right spot in the market. And if it should turn here. If it's in the middle of a trend channel, obviously it doesn't really matter anything because it's still in the trend channel. Or if it's like nowhere near resistance or support, yeah, obviously it can go anywhere it wants. It's at those potential entry points where you want to know what's happening. And this is where the price action candle formations help you decide. Now, what if the market is stalling out and you're not really getting anything and it's not really developing anything specifically? Well, in that case, we also have price action in the sense of chart development. And this is more common in minors and exotic pairs where you don't have as much price action, where, you know, because there's a lot more volatility, so you get a little bit more distorted patterns. But then you get things like a double top or bottom. And I know most of you've heard of this because it's technical drawing 101, basically, to look for things like this. A double top or a double bottom is very simply this. Right, you have the previous heights and the previous heights, they're connected. Preferably you want this wick is just touching it. Now, if we look at some previous history here, no, that's pretty straightforward. Here we have a triple bottom. Right, so here we have 1, 2, it was a double bottom. Here, this part, it's a double bottom, and it did go up after that. Then it turned around, went back down, created a new low, but within range of the wicks. And in this case, made a very, very big morning star. And then just went up. And this is on 4 hours. Right? You can find them on 5 minutes. You can find them on 15, 30, an hour, 4 hours. It doesn't matter. Whatever your trading chart is, what you like to trade in, and whether you are a short-term time trader, like a day trader or intraday trader, or a long-term trader, like let's say you hold it for a week, 2, or maybe a month, We're not doing 6-year trades here, but this is basically the kind of extra confirmation for your entry and exits that you can utilize. For instance, let's say you're in this downtrend, it pulls back a little bit. You expect that to happen, then it goes back again, and it stalls at the exact same level it did before. If we look at these bodies here, then you know from experience, and in this case, price action, this has lost its momentum. This is when we talk about momentum. This is where it's lost it, and you can see that it started consolidating instead of continuing whatever that downtrend was. Right? So we had this going. And this is really quick and dirty, by the way. Look, hey, did you hate it when the things don't work with you? So we have this that then accelerated down, so it looks a little bit like this. Right, so here, green, that one can't close open, doesn't matter. So this is the whole thing where it pulled back, it didn't break, and then here it started stalling. So you created a double bottom. It's literally and the neck of this. It created basically a resistance, and now you're in this little corner. That for most traders would mean time to close the sell. And because most traders think that, you get that switch in volume from sell to buy because all the sellers are closing positions, meaning the buyers are now overtaking, giving it that initial push to break, and then it just continues. You always have a few that go back in with the sells, but eventually you can see here that it just completely loses momentum. There's no market movement. Candles get very, very small, and then it just flatlines for a few hours, and boom. And that's where we're at now. So now it's retesting this. Okay, obviously you have to factor in fundamentals and market conditions and geoeconomics and blah, 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 blah. But based on purely price action, double top, double bottom, pretty straightforward, right? Let me see if your CHF has a nice double top for us to see, because it usually does. This is dirty, I think. Yeah, it is one, but it's dirty. Oh, perfect. Smack dab. Right, wick, wick, wick. So this is a very, very strong resistance that it just could not get through. I'll take that line out, by the way. So, right, so this is the first one. It wicked there, and then it wicked again, and then body again, tried to wick through it, didn't work. So the wick can go through it, that's fine. But wherever the body closes, that's important. So here it's basically your confirmation of double top. Then the next high was lower than the previous high. Now it's over. Okay, now you just know this will just start whittling down. And it did. Like, all the way here. And then this happened. Which is, what was 2020 November? Something fundamental. COVID, I think, may have something to do with everything. Right, so this is important to understand. I don't know what that is. What are you? Right, so that's pretty straightforward, double top, double bottom. So let's take a look at head and shoulders. And this one is kind of like the three pyramids of Giza. Two small tops with one big top in the middle, creating a head, which is slightly higher, and then two shoulders just underneath it. And that usually means that it's basically now going the reverse direction of where it was. So let's try to find one real fast. No. Whoops. What did I just do? Okay, let's do GBP USD. That one usually has a few. Let's see in the day, because in the day candlestick developments are a bit more. Let me just zoom out so I can see it a bit faster. Yeah, sort of. Oh, we want it a little bit cleaner, so you have a good understanding. You're basically looking for an inverted W. And no, they're not as common because these are chart developments, right? So they're one of many, and some just have it more than others. So we're looking for, yeah, that's inverted. Let's see. No, because this is a double top again, right? We just discussed double tops. This is a very dirty head and shoulders. It is one, but I want that clear. Ah, wait, my old friend GBP JPY is usually full of it. Couldn't find this earlier. No. No, that's double top again. Okay, so take this example. We have a high here and a high here. So if there was a high on this side, so you go up, up past the previous high, then down underneath it again, and then back up and hitting the same spot as the previous high before the high, that's a head and shoulders, which was staring me right in the face right next to ours. Right, so here you have one level, and here you have a head. So the line looks like this. And then it usually just says go straight down because it follows whatever it previously did. If you see this pattern develop, so the second you have the second shoulder, it determines like there's way more pressure for down. Now it might pull back a little bit, and it did in this case, right? You have this little bit pullback, which is standard pullback to 32 for those that do Fibonacci. But eventually it still went down all the way to the bottom here. And that's all as a result of this high not equaling afterwards. So, right, so this pattern is a head and shoulders. Now you have some are a little bit dirty like this, and in some cases you get them really clean. Like here we have it a little bit slanted. Yeah, no, this one's not nice. Whoops. I think, but you guys get the point, I think. This is the inverted version. So we go down here, we create a new bottom, we go up, pull back, create a new bottom, pull back, and stall out at the previous height. A little bit slanted, but we have the same pattern again. This is the inverted one. Okay, now obviously the ideal scenario is that this one is exactly equal to each other. It wasn't because it's right here, but GBP JPY is a little bit like that. So there's a little bit of in the pattern department. That is what the head and shoulders look like. So you ever find point A, point B, point C, and point A and C are equal height, and point B is the higher or lower, then you found it, right? You find a W or three mountains, right? So that's head and shoulders. Now the last one is cup and handle. This is a little bit more uncommon, mainly because it's a little bit of an odd pattern, really. But what you get, and I did want to show it to you because it happens quite often, but people just don't know about it. So you have a down here and an up here. And then you get this like where it seems to stall out, but not really. Well, this is what we call a cup and a handle. Because if you follow these three candles first, and then this wick and then that bottom, this formation is called a cup and a handle. It's kind of like a coffee cup. And that usually means that wherever this breaks, and I'm just using, let's say, this candle and these three. So I have just this one, the red one. So I pull it over like this. And from the top, I pull it over the bodies as well. Then whenever one of these two lines, this top line breaks, right, it usually has a determination. Now, in this case, you had this little gap opening, which is usually never a good sign. When you get this revert, and then it did another cup. But this pattern is always good to know in case, because if you would have gone in straight away after it broke, confirmed, you opened here, you would have gone out there. But yeah, you wouldn't trade it on a Friday because this is just bad timing, right? So again, right, you have to keep in mind the other factors of technical analysis. So here's a resistance, like it did break, but it literally broke underneath the resistance and it kind of closed on a Friday just above it and it didn't continue the day after. Right, that's where the gap opening came from. So you can understand that candlestick or chart development is already a little bit more tricky because there's a little wiggle room in reading it. And they're more common in commodities. Like for instance, commodities have a little bit more, I need to go to a day. Like here you'll have a triple top, here there's a double bottom, right? Because commodities you trade in a longer period, generally speaking, you want to look at them in a bigger picture. You don't trade gold on 5 minutes. You can, you shouldn't. Like it jumps way too much for that. Like if you do 4 hours, I already call you pretty reckless, but so keep that in mind. So let's just go through the last bit, and that is how do you put all of this in action? So step one is you do your technical analysis, right? So you do your resistances, your trend lines, your indicators, your Fibonacci, whatever it is that you're using, put all those things first. Then if you identify a potential price action, you always wait for the candle or chart formation to finish. It needs to confirm by closing. So if you're watching on a day candle and you're seeing a morning star develop, for instance, you have to wait till the end of the day and the candle closes and confirms the price action. And then you take the second the next candle opens, that's when you go in. You don't wait to see what the next candle does. You just go in, right? Because you already have your technical analysis from step one, confirming that it is an entry point. You now just want the price action to confirm it. Step two, once you've closed the candle, you can identify the possible price action and its implications. Because before that, you can't identify it, right? It might be a candle, it might be an engulfing candle, but it needs to close in order for you to identify it, which is step 2 and 3 are basically at the same time. Now you might see 2 out of 3 candles form, but you still need to wait for the third candle to close to identify the price action, right? If that makes sense. So 2 and 3, you can switch them around if you want. It doesn't really matter. They happen at the same time. Step 4, as all of you are, you have a step-by-step rule book on applying how your trading entry and exit goes and how you go into the market and with what lot size and how to set up your risk management and micromanagement and all that. So step 4, apply your trading strategy rules, right? Factoring in your exposure and, well, basically everything, right? Your flow book, right? Everybody does that, right? That made you think? All right. Step 5. This is where you basically decide if all the previous 4 steps confirm a buy or a sell according to all the variables, Then step 5 is where you make the decision to either initiate the trade on the start of the next candle or abandon the trade because you feel it's a false signal. And this is very simple. If your technical analysis all say buy, but the candle formation is a sell candle formation, right? So a negative candle formation. Then you have the market telling you one thing, your indicators telling you another thing, and your entry point for a potential sell or buy may be confirmed, but it's not giving you that 100% guarantee. It's not guarantee is not a bad word. It's not giving you that, across the board signal after signal confirmation that you go like, okay, this is really, really strong in the confirm go. Then you abandon the trade. And this is more applicable to people with a smaller account. So anything under 1500. You want to only pick where everything says yes at the same time. Simply because you just don't have the buffer. You cannot make 50 bad trades in a row. If you have 10 grand, you don't really care. You'll recover, right? You shouldn't have 50 bad trades in a row because then you're definitely doing something wrong, but you get the point. Then step 6 is obviously the micromanagement of your trade. Now, here I do want to mention, it is not realistic for, and this is what I hate about a lot of people to say like, okay, you should micromanage your trade. It is not realistic for me to expect you to sit in front of your computer or monitor with your phone all day long. How is my trade developing? And I already hate the fact that you're trying to use your phone anyway, because it just doesn't work. But this is why there's a lot of different steps that you should utilize that are less optimal than manually doing all the management yourself on the fly. But it will allow you to still go to your meetings, to do all your work without having to worry about your trade and safeguarding entry points automatically and things like that. For instance, trailing stops and things like that, pending orders. They're less optimal than manual execution and manually moving stop losses and doing micro and macro management of your trading. But especially at the start, it's better to just give in because remember, if you go out at 0, you didn't lose money, you just lost some time. And if you're looking at a consistently profitable account over the years, taking a few zeros is much better than taking a bunch of minuses. Because I've never heard anybody complain about winning money. I've only heard them complain about losing money. And going out at 0 just feels bad, but it's not bad because you didn't lose money. You lost time. Try again. Okay? Now, for those that are on the recording, I'd like to thank you all for listening. I hope that tonight has taught you something and that you can apply this to your trades. Remember, with Legacy FX, they are more than welcome to answer all your questions that you have, and we hope to see you on the next webinar.